Apes and apettes, welcome back to the channel. Let me tell you guys a fact here. Over 50% of stocks in the markets are down below their October lows on the S&P 500. That means that stocks have already crashed. The crash has already happened. But when you look at the NASDAQ, it's at a new 52-week high. Tyler, what are you talking about? Well, it's concentrated in a couple names. And I think there's going to be some catalysts on the near-term horizon that are going to put a lot of pressure on those big tech names. Now, that's going to also put pressure on shorts, hedge funds, and institutions, and specifically with some of the shorting mechanisms hedge funds are using right now on AMC, it's going to put even more pressure on them. So we're going to get into everything you guys need to know. This is going to be somewhat of a stock market crash update, even though stocks have already crashed. Really, you're just waiting on like 10 or 15 names to come down, and the indexes will come down at that point, guys. So let's get into all of this information. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Now, first thing I want to point out before we get into some of these catalysts is the fact that AMC stock was down 3.69% today. We were down. But AMC stock is up 0.64% here in after hours. What's happening in after hours? Well, the S&P is actually falling. The S&P rallied in regular trading. So you're seeing this inverse relationship happening today with AMC stock. Who knows if that continues? But what we're seeing right now is an inverse relationship. So even as the markets, the big tech names do fall, what will likely happen is your stocks that have already crashed will start to outperform. So whether you are solely an investor in AMC for the MOAS, or whether you are an investor in the broad markets, or maybe you're both like I am, that's a big opportunity as well. Going long on some of the beaten down names right now could be a very good strategy as well for your long-term portfolio. Something like a PayPal that continues to hit a 52-week low almost every single day, that is unjustifiably getting beat down. Maybe that recovers on some of your reddest days in the index over the next couple of months. Maybe a stock like that will start to outperform when the broad markets start to fall, because again, stocks have already crashed and they are continuing to crash, especially on a day like today. The Russell 2000 was down about 1% today. The NASDAQ was up 2% today. Huge divergence here. But the mega, cap companies, the trillion-dollar companies, they're the big dogs here. They are the market. When you boil it down to an index, those guys move the markets. Your small caps, mid caps, even large caps, they don't. Now, what's interesting about AMC is it's a risky stock. It's a risky stock to short. That is why lenders of AMC require high quality collateral, which happens to be an Apple, a Microsoft, a Google, an Amazon, a Tesla, a Nvidia. The stocks that have went to the moon unjustifiably, right? This AI bubble, even if it does have long-term potential, in which I think it does, running this far, this fast is unjustified. And eventually the chickens will come home to roost, as Wolf of Wall Street would say. So I think you're kind of in that moment of time where, one, I think AMC stock might just outperform as some of the small and mid cap stocks outperform when big tech does fall, but it's also going to dry up liquidity and put a lot of pressure on hedge funds as well. So when we dive into some of these catalysts here, and I am going to give you guys an update on AMC's short interest, on the option activity for the day today as well. But I want to start with the catalyst. Now, the number one catalyst right now is obviously the debt ceiling. Raising the debt limit is important, even if you are a bear, even if you want to see the MOAS. Maybe that's not the right way to phrase it. Maybe you would benefit, right, if we had the MOAS and we defaulted on our debt. But by and large, you don't want the US to default. That might mean a 12% mortgage rate. That might mean a 40% car loan. That might be 50% interest rates on credit cards instead of what we're used to. It's going to mean a lot of people losing their jobs, millions and millions of people. It's going to mean very bad things for the economy. I don't think that's going to happen. I think they would pass a stopgap funding bill, before that happened. But what we've seen in the past before in 2011, this is something I've talked about on the channel before, is just a credit downgrade on the S&P 500 or on the US economy will cause the S&P 500 to drop. Last time around when Standard & Poor's downgraded United States credit, the next trading day, the S&P fell 6.5%. I think you could see something similar this time around. Now, again, I think if you did get a credit downgrade, it would happen relatively soon, potentially in the next 36, 48, 72 hours from now, as we do get closer to the debt limit or default, right? So I think that could come either way. Like Fitch Ratings said yesterday, even if we get a deal on the debt ceiling, we might still get downgraded. And again, this has only ever happened one other time in history, and it means higher interest rates. It means higher cost of capital. So I think at this point, it would affect mega cap stocks the most. And I think actually small and mid cap stocks might be able to rally. I think it could be a very bullish event for mid and small cap stocks. It could start to mark the bottom for some of those names, and it could start to bring some of those mega caps down, which would squeeze collateral, which would squeeze margin from this market. Because like I said in the beginning of this video, hedge funds, they are shorting small and mid cap stocks and going long on mega caps. Well, those mega caps have massively outperformed. The small and mid cap stocks are already at lows. Are they going to fall more than mega caps at this point? Probably not. I would bet my whole entire portfolio on that. Now, as far as the latest updates that we got, it's sensitive, I guess. Quote, "We're at a sensitive phase with sensitive issues that remain," said GOP Republican Patrick McHenry, one of the negotiators. So obviously taxes and spending are the hurdles here. I think eventually you do get a deal, but I think it's very well likely that you will get a credit downgrade. And that could obviously come with little or no warning, and that would obviously be a negative thing for the markets, but it would probably be worse for mega cap tech names just because of how much they've already rallied off of really future hopium here. Like AI, sure, AI is going to be huge 20, 30 years from now, maybe 10 years from now, but how much revenue are you really going to bring in the next couple of years from AI? Probably not that much. Okay. Now, if we take a look at the data that came out today, by and large, you've seen strong economic data, which is not what the Fed wants to see. The Fed wants to see a slowdown. And you've seen good data on personal spending, personal income, really inflationary pressures. So good economy, bad inflation is really the narrative of what you've seen today. And kind of throw in there bad housing data. Pending home sales, month over month, was expected at 1.4%. It came in at 0%. Pending home sales year over year came in at negative 20.3%, expected at negative 19%. So a lot of weakness still in housing, but rents are not falling, which is ultimately what affects inflation. Now, if we take a look at tomorrow's data, I think tomorrow's data is going to obviously be a lot bigger. Now, what also happened last time around, I want to acknowledge this while I'm thinking about it. What also happened last time around when the credit rating was downgraded for America, is that actually happened Friday in after hours on August 5th, 2011. So they like to, at least what we've seen in the past, downgrade America's credit when stocks are not open for trading. Maybe they think it'll lessen the impact of a fall or something. So it wouldn't surprise me, okay, if we did get downgraded on Friday or some point over this weekend. Now, for the data that we get tomorrow, 8:30 in the morning, you're going to get durable goods orders month over month for April. You're expecting negative 1.1%. Last month's reading was positive 3.2%. So believe it or not, it might be worse if durable goods orders come in flat or positive, because that's going to show, obviously, economy's not slowing down. Inflation probably going to continue to ramp up higher. Core PCE price index month over month, expecting that at positive 0.3%. Last month's reading was positive 0.3%. Personal spending month over month for April, expecting that at positive 0.3%. Last month's reading was 0%. So PCE, you're expecting that to just remain high. Personal spending, you're expecting that to go up. Inflationary, right? PCE, personal spending, inflationary. Personal income, expecting that to also be inflationary at a 0.3% month over month gain. Last month's reading was also 0.3%. So you are expecting slightly inflationary numbers here, but really not too much of a change from the last, month's data as well. So not very good. Now, also the final estimates or final revisions from the Michigan Consumer Sentiment Survey for May will also be coming out. Inflation expectations will be key. What you've seen with the one-year inflation expectations recently is a rise from March 3.6% to 4.6% in April, down to 4.5% in May. If this gets revised higher, that's going to be the worst case scenario, call it, for inflation becoming unanchored. The Fed touts over and over again inflation expectations remain well anchored. They're starting to become unanchored. Now, what's more important than the one-year inflation expectations is the 5-year inflation expectations. You have seen that go from 2.9% to 3% to 3.2% in May. If that gets revised higher, that's going to be a very negative thing. These are the highest inflation expectations on a 5-year basis that you have seen since, 2012 for one reading. So if you go higher than 3.2%, you're going to be going to levels we have not seen since 2008 or 2007 for a brief period before the financial crisis. And that was only at 3.4%. 25 years you would have to go back to see inflation expectations that high. If they just go up another 0.2. So you're really getting to an extreme level of inflation expectations. Kind of if you look at the 80s back here, right? 70s and 80s, where inflation was a problem before, you can see really ever since then, you've been on a downside trajectory with inflation expectations. You're starting to make a longer term, upside move in these inflation expectations. If that continues, the Fed's going to have to raise rates more, and they're going to have to be more aggressive than you would like to hope if you are a owner of stocks. Now, all of this, put this into context with AMC and squeezing out shorts from their short positions, really kind of squeezing down on that collateral. And that could become a big problem for hedge funds very, very quickly. Now, also, if AMC does continue to inverse the markets, if the markets do start to fall and AMC does catch a trend and start to rally, I think that could also be a very, positive thing. Now, that's kind of strange. If we look at the order book right now, you are seeing almost 19,000 shares that someone wants to purchase at $4.65 per share. That looks like it's going to be a very solid level of support. And interestingly enough, we just recently seen the short interest go from 25% to 21%. Now, we can argue if this is manipulation or what's going on here, but the fact is the short interest is much higher than that. When you look at the shorts market makers have on AMC stock, the short interest is well over 30% still, even with the short interest going down. And that's to mention if shorts actually covered or if they're just manipulating the data. I could talk about that for a while. I don't want to get into that too much. We've already touched on that. But really here, with options, they're a lot more kind of make it or break it, right? With these options, if AMC stock does start to rally, a lot of these options will be closed out, and you will see a gamma squeeze from the market makers just based off of hedge funds selling those options. It's going to let hedge funds, or it's going to let market makers, I should say, buy back some of those shares, which could then lead to a rally in AMC share price. Now, on the other hand, like I said in the last video, short interest actually dropping in AMC is a very bullish thing for the next court update that we get. Because why are shorts covering on their short positions? If that's really what they're doing, that would signal potential good news coming over the near-term horizon, which I think is very exciting. Now, this headline's coming across as well. Cineworld looks to emerge from bankruptcy in July, citing lender backing. That's positive. We're not going to read all of that right now, but that is a very positive headline. So we'll see what does happen. If we take a look at some of the cost to borrow rates that I want to look at right now, cost to borrow rates remain stupid high. 71.3% for the cost to borrow average, cost to borrow max 109%, cost to borrow minimum 55.4%. Interactive Brokers has a 50% cost to borrow fee currently on AMC stock, 21% short interest of free flow, and 108.42 million shares that are currently sold short. So, with all of that being said, AMC stock is at key levels. Or I should say, really bounced off of key levels today. The low that we've seen on April 24th was $4.64 per share. The low that you've seen today was $4.62 per share. You did bounce towards the end of the day. And here in after hours, now you're sitting at $4.73 per share. If you get back into that demand zone in between $4.80 per share and $5 per share, that's going to be a very good sign. But as long as we just stay above this level that we've seen in April, I mean, you're not the most bullish looking chart right now, but people might start to buy this up, especially if shorts covering, if they did cover, means that good news is on the near term horizon. So I'm pretty bullish. Let me know what you guys think about this information down below in the comment section. Do you think margin calls, a collateral crisis, could be right around the corner if America does get its credit rating downgraded, or if we do default, which obviously would not be a good scenario? We do not want that to happen. Or just overall inflation getting worse, economy slowing down. How do you think this will affect AMC? Do you think this will help give us the mother of all short squeezes? So thank you for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys also want to come trade with me live in real time, link down below in the description of this video as well. You guys enjoy the rest of your day, and I will see you in the next one.